The United States has to roll over $9 trillion of debt next year. So what does that mean? Is it actually a big deal? And what does that mean for you in the markets? Take a look at this chart right here. What you are looking at is the maturity of US national debt by year. And you can see that most of the national debt is concentrated in its maturity in the next couple of years. There is very little debt due to mature past 2036. When the US government borrows money, they can borrow money for as little as 4 weeks at a time. They can borrow money for as much as 30 years at a time. The really short-term debt that is in between 4 weeks and 52 weeks until it matures are called treasury bills. When the government borrows debt that matures in 2, 3, 5, 7, or 10 years, those are called treasury notes. And when the government borrows for the long term at 30-year or 20-year maturities, those are called treasury bonds. But at the end of the day, it's still just debt. It's still the government borrowing money and paying it back at some point in the future. And important note, for the bills where it matures in 4 weeks or up to 52 weeks, the interest rates or the yield are always stated in annual terms. So if you're getting a 3.5% interest rate and it matures in 4 weeks. So right now, if you go to treasury.gov and you look at the daily treasury rates, you can see what the current T-bills are paying. See, right now you can get a 1 month or 4 week T-bill that pays 3.6 to 3.8%. All the way out to 1 year is about the same thing, maybe up to 3.7%. But again, those are annualized numbers. So you're not getting that every 4 weeks. It's assuming interest rates don't change and you're able to roll that over every single month for an entire year. Then you'd get the full stated 3.6 or 3.7% or whatever. So it's an annualized number. This is not a free money loophole. Back to this chart that we started with. The government has $9 trillion of debt maturing this next year. The entire national debt load is $38 trillion. That means a little over a quarter of the entire national debt is maturing next year, which means the government has to pay that money back to whoever they borrowed it from. Now, keep in mind, the US government takes like $5 trillion a year from us in taxes, and then they spend about $2 trillion more than that, and for that extra spending, they borrow. This isn't slowing down and it isn't stopping, which means this $9 trillion that they have to pay back next year is on top of the $7 trillion they're already spending, $2 trillion of that being borrowed. So it's not like they are going to just go out and tax an extra $9 trillion in order to pay back this debt. They're rolling it over. That means they're going to borrow it. In other words, they will pay it back, but they'll only pay it back because they're also going to be borrowing the exact same amount from somebody else, or in some cases from the same people. So on the surface, this probably sounds like it is an unavoidable catastrophe that is happening next year that literally cannot be paid for, because let's be honest, the government is not going to be able to find $9 trillion worth of new lenders next year. But the reality is, most of the money that they are paying back, most of that debt that's maturing, is going to get loaned right back to the government. For example, take a look at this chart. This is the amount of money that is currently sitting in money market funds. So this isn't savings accounts. This isn't bank checking accounts where all of that cash, or most of it, I should say, makes its way behind the scenes into treasuries. This is just money market funds. You take a look at this chart, we can see it's stated in millions of dollars. And as of the second quarter of 2025, there's 7.4 millions of dollars in money market funds. A million is a trillion. So there's about $7.5 trillion just in money market funds right now. And if you don't know anything about money market funds, that's fine. It's in T-bills. Remember these things: short-term securities from 4 to 52 weeks in maturity. So your high yield savings account, your money market fund where you're getting paid 3 to 3.5% for your cash. Behind the scenes, the money market fund has taken your money and it has bought treasury bills with it. And every single time one of those matures, it just rolls it over back into the exact same thing. The government pays it back and then we loan it straight back again. And even if you don't have your money in money market funds, even if you have your cash just sitting in cash, behind the scenes, it's getting swept into some sort of a money market feature. And that is true in pensions, that is true in 401ks, that's true in IRAs, that's true in brokerage accounts. And even if you do no investing, you have your money in a bank account, oftentimes the bank itself is taking your cash and putting that in T-bills or in longer term treasuries, which means unless everybody withdraws their money from their accounts in physical cash, that cash is going to be in the financial system somewhere behind the scenes making its way into treasuries. And you might be thinking, well, hold on, what if everybody takes all that money and invests it and buys stocks with it? Then all that money leaves treasuries and goes into something else instead. And actually, no, that's a fundamental misunderstanding that many people have about the way money works. Money never goes into anything or out of anything. When any transaction is made, the dollars go from one person to another person's account. When you buy Bitcoin from somebody, dollars are leaving your bank or brokerage account and going into somebody else's bank or brokerage account. But the dollars, same number of dollars, still exist. When you buy gold, dollars are leaving your bank or brokerage account and going into somebody else's bank or brokerage account, and the gold is going under your ownership. But the dollars still exist, they just move locations. If you sell shares of SPY, the shares leave your brokerage account to go get placed into somebody else's, whoever bought them from you, and the dollars leave their brokerage account and land in your brokerage account instead. The same number of dollars exist. And behind the scenes, those dollars are most of the time just going to be going into treasuries, T-bills, notes, or bonds. And that's why this chart, money market fund balances, usually just goes up. This is not a sign of cash on the sidelines. Oftentimes, this is just collateral. And so when we look at the $9 trillion of debt that the US government has to pay back in 2026, the vast majority of that will be automatically rolled over because they're going to pay back trillions of that into money market fund holdings as those T-bills mature. And that cash will still be in the money market funds, and it will just be then loaned right back to the US government by purchasing more T-bills. The reality is most of that $9 trillion will automatically be rolled over, and no one will be the wiser. Pair that with the fact that the Federal Reserve is lowering interest rates at the short end, which disproportionately impacts T-bills, and ended QT just now, and has restarted QE by buying bills and short-term notes, means that now there is new money being created, coming into existence, that is going directly to help this problem out next year. It is a new source of borrowing for the US government. So while you will probably see going into 2026, many people start to panic about this and say, hey, the government's going to default. There's not enough money for them to borrow. The reality is that most of the dollars that they currently owe back next year are going to be rolled right back over into new debt without anybody even knowing, because it happens behind the scenes. So that's not the problem here. The next thing people think is an issue here is the cost of the interest on the debt, because we all remember what the Fed did during 2020, slamming interest rates down to zero, and we know the government borrowed a lot at zero interest rates. And as the government has rolled that over, the cost of the national debt has gone up because the interest overall on the national debt has gotten more expensive. So let's take a look at how much the US government has to pay in interest on its debt right now and what this next year will do to that in terms of the cost of that interest. Right now, we're going to be looking at the United States Congress Joint Economic Committee debt dashboard. You can find this at jec.senate.gov. And you can see I'm recording this on December 5th, 2025. And that's where all these numbers are up to date. Scrolling down on the page, you will find this chart called the average interest rate by security type. If you look at the entire national debt, it has an average interest rate right now of 3.382%. The bills, which remember is stuff that matures in 1 year or less, has an average interest rate of 3.983% right now. Notes, which are 2 to 10 year loans, have an average interest rate of 3.13%, and bonds, which are 20 or 30 year, have an average interest rate of 3.346% right now. So now let's work backwards and compare that to what the current rates are if they wanted to borrow at those timeframes. So for bonds, that's 20 or 30 year. Remember, we're comparing that to 3.34%. Well, the current interest rate on the 30-year treasury is 4.79%. And so if the government right now has any 30-year treasuries maturing and they roll that over into new 30-year treasuries, they'll be paying like a full % more in interest, which in terms of the cost, that's a 25% increase or a little bit more. And the 20-year is no better. It's at 4.76% right now, compared to their average long-term debt cost of 3.3%. So of the $9 trillion that is maturing in 2026, if any of this is long-term debt and they're trying to roll that over into the same maturity, then they're going to be paying more on that. But as you'll see, that's not what they're going to be doing. Notes, that's 2 to 10 year. We're seeing their current average cost on notes is 3.13% right now. The current 2-year yield is 3.5%, which again is more expensive. So if a 2-year matures and they roll that over into a new 2-year, then that debt gets more expensive. And the 10-year is 4.1%. So if they've got a 10-year that matures and they roll it over to a new 10-year, that gets a lot more expensive. So from 2 years all the way to 30 years, any of that debt that they're holding right now is cheaper than what they could get if they issue new debt at those maturities right now. If that makes no sense, just look at your mortgage rate. And let's say you've got a 4% mortgage rate. If you went out and refinanced that to a new mortgage right now, you'd be paying like 6%. That'd be a bad deal. You're going to pay a lot more for that new mortgage. So again, a lot of people are concerned with $9 trillion maturing in 2026. Is the cost of the national debt going to go up because they're essentially being forced to refinance? Well, this is the kicker here. Bills, 3.983%. That is the current average interest rate on bills. And we know that bills mature in 52 weeks or less. As of the time of this recording, we're looking at December right now. With $9 trillion maturing in 2026, we know the vast majority of this has to be T-bills. Why? Well, because T-bills right now have an average yield of like 3.6%. But right now, on average, the government is paying 3.9% on all their bills, which means that a good chunk of the bills that they are holding were opened up over the last year, which means a huge chunk of the $9 trillion that is being rolled over in 2026 is bills. This is the reason why there has been so much pressure from the current administration on the Fed to lower interest rates. The Fed does not control long-term interest rates. When the Fed lowers rates, it really doesn't have much impact on the 30-year, the 20-year, the 10-year. It only has a big impact on the short end of the curve, which is this: T-bills. So for the entire pile of T-bills the government has right now, if they roll them over immediately, the cost of the debt will go down. And in fact, this is the reason why there is so much debt that is maturing in 2026, because for the last year, 2, maybe 3 years now, the plan has been on the fiscal side, we are going to everything as possible. We're going to, as it matures, roll it into short-term debt. We're going to get T-bills, we're going to get 2-year notes. We're going to keep it as short as possible, because at some point in the future, when the Fed lowers rates, we know it won't really impact long-term rates, but it will impact short-term rates. So if all of that debt is maturing, we can take advantage of those low rates in the short term. So the 2 things you'll probably see the most from people talking about this are, number 1, that there's going to be some debt default, big blow up because the government won't be able to roll over this much debt. That's not true. The vast majority of this will get rolled over on autopilot. Nobody will even know, because the vast majority of this is just invested in T-bills behind the scenes with all of the cash that people have in their accounts. Number 2, this will not drastically increase the cost of the interest on the national debt. In fact, depending on the exact composition of what is maturing in 2026, it might even very slightly lower the cost of the national debt. For example, if 100% of the $9 trillion maturing in 2026 was bills and interest rates don't move at all from here, then everything that's in bills costing 3.98% right now will be able to be rolled over into bills that cost somewhere in between 3.5% and 3.8%. But we know that the Fed is not done lowering interest rates. And so the US government will continue to roll everything over into the shortest term debt possible, so that when interest rates finally get low enough, they'll have constantly maturing debt that they can choose when they want to refinance into longer term debt. So the bottom line is, this number I expect over the next year or 2 to actually get larger. More and more of the national debt to get concentrated at the short end of the curve. And we will not see that rolled over into 30-year, 20-year, or 10-year treasuries until some sort of policy happens that pushes those long-term interest rates lower. And that may not be possible without forcing them lower, because inflation expectations, I think, will continue to move higher, which means people won't be willing to lend the government at those higher rates. But if the Fed does yield curve control or restarts long-term quantitative easing, or if they're able to push through deregulation in order to get the banks to do quantitative easing for them, those kind of things could push long-term interest rates lower. And then the government would be willing to refinance. But until those things happen, more and more of the national debt will get concentrated at the short end, and it is unlikely to cause any sort of liquidity issue, borrowing issue, or defaults. As always, thank you so much for watching. Have a great day.